Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
Hello, hi, namaskar. Very important topic. You're going to enjoy this conversation. Banking sector versus IT sector in India. A lot of you would be invested already in banking or in IT or in both. I think after the end of this video, you are going to get some perspective from me that which sector probably you would like to exit or you would like to add. And if at all you decide I want to add, I'm going to give you some perspective again, some methods of how you can add or reduce either of these two sectors. Okay, it's going to be an interesting discussion. I hope you're going to like it. My name is Vivek Bajaj. I've been in market for 20 years and I enjoy this. I enjoy the whole process of learning and sharing the learning. I hope you're going to share this video with your friends because sharing is caring. All right. Let's start. The presentation is right here and I'm right in front of you. Bank versus information technology. What to buy? A data-driven face-off between two very heavyweight sector in India. Okay, and we all know that our country is so much dependent. Our market is so much dependent on these two sectors. Both are critical as far as employment is concerned. Both are critical as far as contribution to India's GDP is concerned. Both are critical in terms of the profitability this sector overall generates for us. Okay, should I be considering a fight between these two or not? I think over a period of time, while I go through the presentation, you come to know this will be there for around 10 minutes. So I'm sure you're going to give me 10 minutes of patience hearing. All right, let's start. So, two giants, one portfolio decision, if at all you are here to take that decision. Okay, we're going to discuss the weightages, we're going to discuss the revenue contribution, the profit pool, the current form, the tailwinds, the headwinds, and what can go wrong and what can go right in both these sectors. Okay, let's talk about the banking sector. So, if I have to, 10,000 feet view about banking sector, that what are the chief drivers which drives this particular sector? The net interest income. Net interest income is very simple in banking. The money which a bank has to pay to depositors and the money which the bank can charge from the borrowers. The difference is actually the net interest income. Number two, margins and rate cycle. This is very, very important because when there is a fall in rate cycle, then when the interest rates are going down, there is a typical tendency of NIM reducing, although the volume goes up, which compensates for the loss of the revenue. But typical thought process is the NIM will reduce. So in 2025, there was a 125 basis rate cut, which actually compressed the margin of banks and stable. And now it is obviously stable because interest rate is not looking that it will fall in any time soon, thanks to inflation, right? Third, asset quality and capital, which is a very, very important concept and point at this moment because what was done many years ago as a bad loans in India across the board, and we have a lot of examples who have taken bad loans and vanished from our country. Uh, the asset quality of Indian banks have gone up. It is a cleaner balance sheet. The gross net NPAs are at a multi-year low, and capital adequacy, which is essentially how much capital the bank has that it will not go into a default mode. The capital adequacy is comfortably at around 15% across the sector. Deposit franchise. Now, it is important to see whether the deposits are going up or not, and that is definitely a concern area. So there are some banks where deposit is high because of the inherent characteristics like public sector banks, and some banks where deposits are low. So CASA, which is the current account and savings account deposit funding, that is very important data to be looked at to consider whether the sector will continue to enjoy the patronage. It's a patronage, right? They enjoy the benefit which the government has given to them. Do you know that banking sector is almost 34% weightage in Nifty 50? And the total revenue contribution of banking sector in FY25 was around $285 billion. That is the kind of revenue this entire sector has generated. Hello, my name is Vivek Bajaj. I have more than 20 years experience in stock market, and I can suggest you, if you are serious about stock market, download StockEdge app. It will really help you in your journey of wealth creation from stock market. Let's go deeper inside the banking sector. So we have private banks, we have public sector banks, and we have small banks and niche banks, specialized banks. Private banks are typically the one which have higher net interest margin, approximately 3.9%, and they're always traded as a premium valuation. Historically, if you see, they've always traded at a premium valuation. Public sector banks has always been a cheaper. I mean, they're perceived to be very, from a valuation perspective, far more better margin of safety. But because public sector is considered to be inefficient, and there were a lot of issues in history which led to people believing that public sector banks are not managed properly. But I think last 2, 3, 4 years, it has been a great run in public sector banks, and whether that will continue or not is a subject of discussion, which we will take it forward later. Then there are small banks like where there are high growth, high yield, and these are the banks who are very hungry for aggressive growth. That's why they cater to an audience which are higher risk, right? Like microfinance or unsecured loan. But obviously they have their own capital adequacy requirement. So it's not that if I lend money to a higher risk category, I will go bust. There are capital adequacy which our regulator has clearly defined for that category of banks. So broadly, there are three category of banks. If you look at what has happened in recent times, the credit growth has picked up slightly. I mean, if you consider the last couple of quarters, the credit growth was 9.5% a year ago. Now it is around 17.7. The private bank NIM is around 3.9%. Capital adequacy, as I said earlier, is around 15%. The gross NPA is low. The credit to deposit ratio is high. That doesn't mean that the credit is growing abnormally. Actually, the deposit is also going down. That's why the credit to deposit ratio is high. And there is fair bit of FPI inflow in banks, around $6 billion, but in 2025. But recently, you see, because of a lot of FPIs moving out, and most of these banks were owned by FPI. So large part of their stake was actually in banks. So they have actually moved out, led to outflow as well in last year. Now let's talk about IT sector. Okay, so IT sector is almost 9% of Nifty weightage. Okay, banking was huge. It is 99%, and it contributes around $283 billion of revenue. What are the key drivers of IT sector? Number one, global discretionary spend on IT, especially by US and European regions in BFSI, retail, manufacturing, because everything is now IT enabled, right? It has been IT enabled for many years now. Labor arbitrage, which was the main reason why our people got business or jobs in IT, because we were cheaper vis-a-vis the cost which is there outside. AI pivot. Now, AI could be a threat and it could be an opportunity also. We'll discuss why it could turn out to be a big opportunity for IT sector in India. And there are a lot of deals which is already getting visible. I mean, the recent HCL Tech deal, huge deal which has happened, and decent operating margin. IT companies work in a very good operating margin level. So right now the growth is not there. There is a problem with IT sector. There's no doubt about it. But whether the problem will become a bigger problem is something which we have to deeply think and then conclude. Okay. If you look at inside Indian IT, so there are tier 1 companies like TCS, Infosys, HCL Tech, Wipro, etc. They have a revenue of 5 billion per quarter and 20-25% margin at a global scale, but the growth is slowing down. Then there is a mid-tier challengers like L&T, Mindtree, Coforge, Persistent, etc. They're specialized in certain things and they're growing because of those specializations, right? Especially in the domain of cloud, AI, etc., etc. And then there are AI pivot businesses like OpenAI and Anthropic. They're collaborating with Indian firms. Like Infosys said that almost 5.5% of their revenue actually is coming from AI. And we heard recent collaboration of Anthropic with TCS, etc. So AI is there. Everyone knows. I mean, we know that there is a scare of AI, but at the same time, You see, all the IT company top management, they also know that AI has to be adapted. Now, whether they will be able to adapt it and use it to the full potential, that is something which, time will say. I just analyzed the market cap to cash of IT companies, overall IT sector, and I saw that in 2017, the market cap to cash equivalent was 25 times, okay, which I went up to as high as 50 times in 2024. Now it has come back again to 30 times. So basically, if you just see the historical 20 to 25 times of cash equivalent is a fair value of IT companies, and maybe a little bit of more correction may be there, but 30 times vis-a-vis 50 times is fairly good deviation which has already happened in the market. I hope I'm not sounding like that I'm bullish on IT. I'm just giving you a perspective because a lot has been talked about in terms of IT not doing good. But we have to think from both perspectives because ultimately opportunity lies in a segment which is down and out and no one is talking about it. Now, if you look at financial services, Nifty weightages, financial services command the single largest slide of Nifty 50, which is almost over 30%, and IT is approximately 9%. So basically, almost 4x of IT is actually banking. And the top banking is SDFC, ICICI Bank, State Bank, and the top IT is TCS, Infosys, and HCL Tech. Now, two different top line stories. Number one, banking, the top line is growing by 14 to 15%, which is a system credit growth. Actually, it's better to look at the credit growth than the top line because if credit growth happens, the top line will automatically grow. Each bank will have its own pace of top line growth. Okay, this was earlier 9.5%. Now it has increased to 14 to 15%. Okay, and IT top line has only grown by 3%. This is the main concern, right? And AI, which is something which is there, and we have to accept the fact that it is there. AI risks 2 to 3% deflation in legacy services. So if AI risk is real and this 3% will probably also get squeezed, so say 1% or so, then the reason why today valuation is in bad shape of all these IT stocks is because there is least growth which is expected for coming few years. And remember, AI has a lot of unknowns also. So today we know what AI is and we can visualize what will happen to the IT sector. But after 6 months, AI will be in a very different avatar. And that time, visualizing IT sector is something which we have to see that time, right? So there is a lot of unknowns now associated with IT sector. But banking is more real economy based, right? Where you see that if economic activity has to happen, banking has to grow. So it's more reality and that is more possibilities. Okay. So who earns India's index profit? If you look at Nifty, who earns the maximum profit in Nifty? So financials 34%, energy 13%, IT 11%, auto 8%, 7%, FMCG and others. Banking profit growth has been around 9.7%, okay? And IT profit growth has been around 17%. So even though we are talking about wrong things about IT, that it will not survive because of the future growth, but in terms of profitability, I think IT sector is doing reasonably well, right, in terms of growth. And remember, rupee weaker is good for IT stocks, right? Whereas rupee weaker is not so good for banking because the purchasing power of citizen goes down if rupee is weaker, which hits the growth at overall level. Banking sector is recovering, IT is under pressure. I think this is something which we have clearly communicated and clarified. Now, banking, what could go wrong? Deposit growth may remain laggard and it may not grow. People are not interested in parking their money in bank anymore. They want to experiment with high risk assets like equity, crypto, mutual funds, etc. There could be system liquidity issue, maybe oil shock, maybe any other thing which can lead to government pulling out the liquidity. Margin compression, if interest rates remains here or goes down for any reason, there could be margin compressions and there could be pocket of stress from microfinance, or maybe because of IT not growing, there is a significant population who used to consume because IT is not growing. And if they stop consuming, the retail story goes down, then there is a possibility of the lending story may weaken, which could have some impact on the banks as well. So it is more impact could be because of real economy thing, and IT impact is largely because of AI, and any kind of shock can come in AI in future. What can go right? If interest rates are going up, NIM recovery is better. There could be credit demand growth because economy will recover at some point of time. There could be fresh funding tailwind which may push because FCNR relief has been given, FPI has started pouring money now, and clean and cheap balance sheet leading to better valuation. Whereas IT, there could be huge AI opportunity in going forward. There could be deals, there could be AI partnership, and finally, it's all about valuation, right? And IT is available at a cheaper valuation vis-a-vis last 2 years. Is it available at the cheapest valuation? The answer is no, but it is certainly available at a cheaper valuation. Okay. Now let me take you through StockEdge and let's see a few things here. That how will I trade if I have to trade or I have to invest? Okay. First of all, let's go to banking sector. Okay. So banking sector. So the way I look at things is that I will go and see which are the stocks which are fundamentally good and trading near its long-term PE range. And we have considered 3-year PE as a fair PE as a base of our discussion of lower PE or high PE. Okay. You see, in stockage, we have given these this beautiful filter also inside. So this output has recently been launched. It's a great output. It's a very objective way of analyzing a stock. So let us see the strong stocks. So these are the stocks: Indian Overseas Bank, Punjab and Sindh, IDBI, Central Bank of India. These are the stocks where there is decent EPS growth and the rating is also good. I mean, you can go inside each and every stock and actually go deeper inside this, look at the ratios, and try to make a judgment on a stock based on few fundamental parameters, which we have also seen historically as part of the ratios. So look at this, and then you can look at the momentum score and look at the stocks where momentum is green and fundamental is also supporting, right? Like for example, SDFC Bank, ICICI Bank, like it is momentum is green right now. And if I search ICICI Bank here, it is 78 out of 100. So, and if you look at the PE range, it's near its lower PE. Although banking clear PE is not the right indicator, but just to give you a layer of confirmation, if momentum is positive and PE is strong, then I would be definitely a buyer in banking. And ICICI Bank could be one of these stocks which I'm ready to buy. Let's go forward. So because I feel that the banking overall is a good story, I may like to look at the stocks which are green here, like Federal Bank. Okay, all three green. And now if I look at the fundamental score of Federal Bank, it is also 78. So fairly, I can try investing in this. So find out stocks which are relevant and add to that basket. Okay. Same thing if I do with IT software. Okay, information technology software. Now let's go into information technology and let's go into the industry software. Same thing if I do, most of the stocks here are red momentum. Okay. Only few stocks are green momentum. So Oracle, Coforge. Now let's take an example of Coforge. Let's go inside Coforge and let's look at the fundamental score of Coforge. It's 76 out of 100, which is not bad. Okay. If I'm a momentum investor, I will not invest in IT at this moment because the entire sector is in red zone. Red zone means no zone. Okay. Yellow zone is still positive. I can still look at it, especially when a sector is moving from red to yellow. I can still look at it. But definitely from a momentum perspective, it is not the right zone. But from a value perspective, that whether there is enough value in this sector, For that, you have to look at the stocks here, okay, which are high rated and which are trading below its P range. So you see these stocks, R System, KPI Tech, eMudra. In fact, this is all IT software, right? These are the stocks where rating based on historical performance fundamental is positive and stock is trading below its P ratio. But that's value investing if you are looking at based on historical performance. But purely from a momentum perspective, I will not invest in IT at this moment. So what do I do? What do I do? Then what's the point of recording this video? What do I do? Well, this is an important slide, and I want to end this with this important slide. Okay, banks, the compounder for now, a domestic structural growth story with earnings tailwind, rising credit, recovering margins, and clean book available at reasonable valuation. The lower risk core holding as the cycles turn up. It is best for steady cycle aligned exposure. So if you believe in current upcycle in Indian market, Indian economy, banking is a better bet. Okay. IT, the contrarian value bet. Cheapest in year with real AI optionality, but earnings visibility is clouded until deal converts and AI questions getting resolved. A lot of questions right now, which is attached with AI. And the question is not ending. And next, the form of questions is changing. Today, the questions which you are asking, after 3 months, what we'll ask, after 1 year, we'll ask, will be very, very different. So, but there is value. So, a staggered SIP style accumulation rather than a lump sum conviction buy. Best for patients, value oriented investors. So, the bottom line is it is not about this versus this. It is actually about you, what you are. If you are a long-term value investor, then it's not a bad idea to start your SIP in IT as a contrarian bet. But if you are an active investor who want immediate momentum or immediate participation, then banking is a better bet. So the honest answer, it's less either or than a question of time horizon and risk appetite. Banking rewards the cycle today. IT rewards conviction on AI tomorrow. And I suggest the best way to invest in IT is to do SIP in mutual funds. Let me show you how you do that. Go to mutual fund section of StockEdge, okay? And here you can search for IT. In fact, you can, not here, sorry about that. Here you can go here, classes, and here you will find sector specific. So here we have technology. You see technology sector has given the least return here, only 5.8% CAGR. Okay, can you see this? Yeah. If I go inside this, not a bad idea to start your SIP in one of these funds. I mean, could be any fund. I think I prefer the funds which has bigger exposure, who have larger asset under management. I think maybe start with ICICI Prudential, because you see the last 5 years CAGR is so bad that this is a sector actually which can generate high return in next 5 years. We do a mistake. We only select sectors or any other fund which has given highest return. Actually, that should not be the case. It should always be one which has not given high return, has a higher possibilities of giving me higher return in future. Okay. All right. So this is it. I think it crossed 10 minutes, but I'm sure you are here till the end. I hope you like the video and plan your trade and plan your investment wisely, because finally it's your money and no one will take care of it better than you. All right. Thank you for watching this video and staying connected with me. Jai Hind.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.